Welcome back to But This Time It's Different, the podcast where we unpack the chaos inside the global economy with always a raised eyebrow and, as of today, a rapidly increasing insurance premium.
I'm Alex Chalmers, a finance and technology writer with a newfound enthusiasm for shipping containers.
And I'm Sinead, a defense and aerospace economist, an investor, and someone who's starting to think the most important part of the world economy isn't the Fed or the ECB, it's whatever's stuck off the coast.
And that's exactly what we're talking about today. Freight, shipping, ports, basically the plumbing of global capitalism, the system that lets you buy an $8 phone case, $2,000 Peloton, if people are still doing that based on the share price. I'm not sure they are, both delivered in the same metal box.
But here's the twist. In 2025, global shipping has stopped behaving like boring infrastructure, and it has started behaving like a volatile emerging market, full of geopolitical risk, speculation, bottlenecks you can literally see from space. In other words, a total shit show. So let's start with the obvious, the shipping map. The literal map of how the world moves goods is broken. And I don't mean this kind of metaphorically. It's not some sort of fancy term for a market cycle. I mean like literally broken. Sea lanes that once kind of underpinned the smooth functioning of global capitalism are now either blockaded, burning, or actually evaporating. And the ripple effects are everywhere, from the cost of your toaster to the availability of your medication to the earnings reports of Fortune 500 companies. All of it is being warped by what's happening at sea.
Luckily, to make this easy for a concise podcast format, there are only a pretty small handful of globally significant shipping lanes. So we're just going to run through them one by one. First up is probably the one that's been in the news most recently, which is the Red Sea, which runs along the Suez Canal and is one of the most vital arteries for global shipping. Since the end of 2023, Houthi rebels in Yemen have started firing rockets at basically any passing ship they thought might have some incredibly tenuous connection to Israel. So this covered container ships, oil tankers, and people who were looking at them funny. And as a result, Maersk, MSC, and basically every major shipping line has had to reroute traffic around the Cape of Good Hope, which is right at the bottom of Africa. And that adds anything from 8 to 14 days to Asia-Europe shipping lanes, as well as fuel costs, labor costs, security risk, chaos at destination points, and it doesn't look like it's fading anytime soon. You may have seen recently that President Trump declared victory over the Houthis in Yemen after dropping $1 billion worth of munitions on them in 1 month and failing to end any attacks. So this is unlikely to be a one-off incident. It's a structural rerouting of global trade, isn't it, Sinead?
Yeah, I mean, if that doesn't make you nervous, let's jump into number 2, which is the Strait of Hormuz. Not much better here. So this is a narrow passage between Iran and the UAE that handles around 20% of the world's daily oil supply. So no big deal. It's not officially blocked right now, but it has become what, I don't know, Alex, let's call it a high-stress zone. Iran's Revolutionary Guard has been harassing or boarding tankers, especially those flagged to Western allies or aligned with Israel. So insurance premiums have tripled. Naval escorts, remember those? They are back. And every company shipping there is budgeting for escalation. Even the rumor of a disruption in Hormuz sends energy prices rippling through commodity markets.
And sort of recently back in the news was the Panama Canal after Donald Trump instructed that it be handed to the United States. But maybe it's not worth the trouble because due to climate level drought, water levels have now fallen so low that the canal can't actually accommodate large vessels at full capacity. Traffic is down somewhere between 40% and half, and ships are now waiting days or weeks to get through, or they're just skipping it entirely and rerouting across the Pacific or through Suez, which isn't great either. So alongside war, the infrastructure of globalization is now running up against climate constraints.
Right. And put that all together, and the global trade map doesn't look like this kind of finely run network anymore, which it did for a long time. It looks like this weird, massive game of battleship, but literal battleship, okay? Except instead of sinking vessels, we're just making them slower, riskier, and radically more expensive. And the outcome, apart from Houthis shooting at everything they see, is bottlenecks, delays, spikes in the cost of shipping, all of which bleed into every industry in ways that we know investors and capital markets hate the most: inefficiencies and inconsistencies.
So the boiling of the planet and rockets flying in random directions, random ships being boarded wasn't bad enough. An added element of chaos has come from the world's policemen. So while we are currently so back, if the markets are to be believed at the time of recording, the Trump administration a few weeks ago threw a pretty major spanner into the works when it introduced tariffs. With additional duties on battery, steel, aluminium, semiconductors, and consumer electronics, chaos was unleashed pretty quickly in the middle of these already fragile trade lanes.
Yeah, the effect was pretty immediate, as a lot of the data shows us. So container volumes from China to the US already dropped by 30 to 40% within weeks. Shipping companies are scrambling. Some are slashing capacity, others are desperately rerouting cargo through third-party countries like Vietnam, Thailand, Mexico, trying to mask the origin and avoid all of this tariff shenanigans. It is a logistical arms race, and the winners so far, no one, apparently.
Yeah, when the cool people in Guardian columns talk about deglobalization, I think this is sort of what they're usually driving at. We're seeing companies having to re-gear their supply chains on the fly. Shippers are guessing where the next tariff will hit. Pricing models can no longer rely on even remotely stable assumptions. And geopolitics isn't just affecting demand these days, it's now physically rerouting the movement of goods.
And just like that, freight becomes foreign policy. So it's really no longer just about what's inside the container, whether it's coffee beans or circuit boards or whatever 5,000% tariff increase food is in there. It's really about where it came from, what flag it's flying, and whether it crosses the wrong line on the map. And this is what we mean when we say that freight is behaving like an emerging market. It is being priced in real time by risk, war, climate, politics, not just distance and demand like it used to be.
But shipping is one of those things which, when you look at it as an outsider, it often feels a bit invisible. People just imagine ships that are these lumbering giants that float stuff around, but once it stops working, you realize it's a little bit more organized while also being significantly more fragile than that.
Yeah, and at its core, global shipping is just one giant coordinated game of floating Tetris. You've got these massive container ships. Alex, some of these are actually longer than the Empire State Building. It's tall, so if you imagine that inverted, these are huge. They're carrying up to 24,000 containers each. And each of those containers is this kind of standardized metal box, 20 to 40 feet long. Inside those containers, all the weird shit that you've been ordering from Temu, like sneakers, solar panels, key rings, frozen chicken wings. One container might be holding $30,000 worth of bulk rice. Okay, and the one next to it might be packed with designer handbags.
Yeah, and these ships don't operate randomly. Someone doesn't just load stuff onto a ship until it's full and then sends it on its way. They run on these fixed schedules like bus routes. So a single vessel might do Shanghai to Singapore to Rotterdam to New York on a repeating loop, dropping containers off and picking up new ones as they go. It's not an easy business to make money in, perhaps somewhat unsurprisingly. Margins on these trips are razor thin. Companies only make money if they fill every possible square inch of deck space with containers. If a ship sails half full, it loses money. If they get delayed, they then lose even more. So timing and efficiency are everything. Both of those are being roundly fucked at the moment.
Why, it just reminds me of Ryanair flights. If you've taken a Ryanair flight, they're at 99.9% capacity to break even.
And that is why Ryanair is basically one of, I think, only 4 or 5 airliners in the history of commercial aviation that has not gone bankrupt or had to go through a major financial restructuring. So the Irish are onto something there.
Okay, so let's actually save this for another day, because I could 1000% talk about this all day, but you're 100% right on that. Just to get back from aviation to shipping, I spent a week in Argentina at one of the world's largest ports. The operational expansivity of this is mind-blowing. But the shipping line is just one part of this fucking insane picture. The real magic, or mess, depending on which way you're now looking at it, happens in the coordination between all of this stuff. And that's where freight forwarders come in. They're these high stakes travel agents for cargo. So they don't own the ship, they don't own the port, but they do coordinate the whole journey from the factory loading dock to final delivery. They book the space on these ships that you were talking about. They deal with, oh my God, the customs paperwork, the handling of insurance, rerouting around delays, all of that. The worst imaginable cluster of logistics you can imagine are done by freight forwarders. And this is where the model starts to change. So for decades, freight forwarding was this opaque, fragmented world of spreadsheets, fax machines, phone calls. And as someone who's had to work with these companies before, I can assure you handwritten systems. But then along came Flexport, this startup that said, let's make this digital, which seems like an insane thing to want to do. And now you can track your container like you track your Uber. You can handle custom stocks in a dashboard, real-time visibility. Apparently that is now a thing. And so basically, this is where shipping meets Silicon Valley.
Yeah, I mean, I actually, pre-Flexport, I had a friend who spent 5 years trying to convince me that the real solution to shipping was the blockchain, which I can kind of see what they mean when you describe the code of handwritten like paper record shuffling, but it never seemed to happen. But Flexport on the surface does sound like a great idea, but unfortunately, you can't sass your way out of being RPG'd by the Houthis, and it still has to rely on the same set of like broken ports, weather patterns, old ships. But no matter how nice your app is, the container still has to get from Vietnam to Long Beach. But at the same time, it can work, and when it does work, it's pretty beautiful. When you get to a world where a laptop made in factory in Shenzhen gets packed, sealed into a container, loaded onto a ship, and arrives at your door halfway across the world 3 weeks later, having crossed 2 oceans and 4 jurisdictions for $300 in shipping late fees. It's pretty mental.
Yeah, but that system is now completely broken, it seems. And what happens when these trade routes catch fire? Like literally or figuratively, it really doesn't matter anymore because shipping routes stop behaving like infrastructure, which is how we've traditionally always priced them and dealt with them. And they start behaving like hedge funds. And that's really not a metaphor. Now I'm talking about this in very measurable realities.
Yeah. So if it's a bad time to be a freight operator who works with razor thin margins, it's a pretty good time to be in the insurance business. If you're an insurer and a freight operator goes through a conflict zone, you get to charge them a war risk premium. And you'll perhaps not be surprised to hear that in the last couple of years, these have surged in the Red Sea. And for some routes, that premium has jumped up by as much as 500% in 6 months. Some carriers are now paying over $500,000 just in insurance costs. And that kind of risk pricing affects everyone from container liners through to oil tankers. And unsurprisingly, that cost has to get passed on to someone.
Yeah, remember during COVID when shipping just got insanely expensive? Well, we're kind of back there again. Prices are vertical. The average Shanghai to Rotterdam spot rate, which used to hover around $1,000, $2,000 per container, it's now over $4,500. That is a 250% year on year spike, and we're still in Q2. I suspect things are going to get hairier later this year. And that's not just on these war affected routes that we're talking about. Because of the rerouting and the bottlenecks, ports like Singapore, Antwerp, Jebel Ali, they're now seeing massive backlogs. So where ports used to be really busy, they're empty, and ports that are now empty are now very busy, even though these ports are technically not in the conflict zones. As we have seen with nearly every complex system, when one part of the system breaks, the whole thing falls apart.
Luckily, the financial world it's not a place where a good crisis is left to go to waste. So obviously freight is now being traded and speculated on and hedged. You've got hedge funds going long container leasing companies betting that as ships reroute and capacity tightens, demand for containers will spike. Now others that are going short freight volume, expecting that the geopolitical pressures we described, trade slowdowns, will just kill demand and bring spot rates crashing right back down.
I mean, investors are nothing if they are not intuitive and experimental when it comes to trying to find new ways to make money. So on top of that, you then have the emergence of this new thing called forward freight agreements or FFAs. You can think of them as futures contracts for shipping. We're literally creating this new market around freight. You're betting on what the price of the moving container is going to be from, say, Shanghai to LA. next month, next quarter, next year. I mean, this is gambling Reddit style. These used to be niche derivatives, mostly used by big industrials like oil majors or bulk commodity shippers. But now you've got trading desks, actual hedge funds speculating on the rates and how expensive it's going to be to get your shitty iPhone from port A to port B, as if it's an oil future or some sort of emerging market currency.
Yeah, and it's not just the degenerate gamblers who work for hedge funds doing this. Retail investors, and I cannot stress how much this is not financial advice, through ETFs, logistics stocks, and even some synthetic plays are indirectly exposed to all of this. So if you've got exposure not just to shipping companies or port operators, but also downstream retailers, your portfolio is suddenly a participant in all of this madness.
Yeah, and this is what happens when you financialize infrastructure. I mean, we're not going to become the socialists on this episode yet, but you take something physical, whether it be a ship, a port, a container, and you turn it into a risk asset. If these are suddenly not about moving goods from A to B anymore, you're now sitting in a hedge fund, managing volatility, pricing your exposure, structuring and restructuring, endless payouts. And what used to be this really sleepy industry that honestly none of my friends ever wanted to get into, and kind of looked down on it, those who were in it with the fixed lanes and the fixed timetables. This is now like a hedge fund's derivatives playground. It's a dream.
Yeah, in many ways, shipping is actually sort of, I hate to say this, the new oil. Yeah, I remember when data was the new oil, but now shipping is the new oil. Let's go with it. It spikes on geopolitical risk, collapses on recession fears. It's priced by drones, droughts, tariffs, not just distance or demand. And I'm feeling physically sick as I say this. The ocean is starting to look a little bit like a frontier bond market, sort of volatile, unregulated, and moving faster than we're able to keep up with. But much like a frontier bond market, when things become chaotic, some people begin to do pretty well out of it. This isn't all bad. This isn't all a tale of woe. There are some winners and some losers. And Sinead, who are some of the winners?
We are not, as consumers, are not the winners right now. But you know who's a winner? India. So its ports, especially the Mundra and the Navasheva, they're suddenly seeing this massive spike in volume. Why is that? Because so many ships that would have gone through the Suez and up to Europe are now rerouting. And India is actually perfectly placed as this kind of pivot point or stopover. And Indian exporters are benefiting from this China plus one strategy, which we should really get into sometime soon, because this is where global companies are looking for production bases outside of China, but that brings freight volume with it. Then you also have the UAE. I already mentioned this before, but specifically the Jebel Ali port in Dubai. This has become one of the most important neutral hubs in the world. It is modern, deep water, politically stable, and crucially, it is not sitting on top of a war zone like a lot of other places. It is currently able to absorb the overflow from East Africa, the Red Sea, South Asia. We also talked about Mexico. Thanks to reshoring trends, Mexican ports like Veracruz and Manzanillo, they're booming, with US tariffs hitting Chinese goods hard. And I don't even want to comment on this because I feel like it changes every day at the minute. But more companies are moving production to Mexico to serve US market tariff free, which means that more containers, more rail, more port traffic for Mexico. Now, Alex, tell me about the losers.
Oh, I think top of the list is Egypt, who I feel bad for. I just remember I was looking a couple of years ago, could I be a retail investor in Egyptian government bonds because they were yielding at 36%? But yeah, the Suez Canal.
We need to create some sort of list of these weird emerging market investments that you either made or tried to make that were horrendously bad.
Look, Egypt has not defaulted on its debt, so I don't understand why that would have been bad. But anyway, Suez Canal normally brings in about $9 billion a year. You know, it's this cornerstone of Egypt's somewhat struggling economy, but traffic's down over 60%. They're reportedly losing $800 million a month in revenue. If you're struggling with inflation, debt, currency pressure, and wannabe bond market vigilantes like me, then it's pretty devastating. Beyond Egypt, sort of moving east and southward slightly, Kenya and Tanzania, all these countries that were in the process of becoming potentially big logistic hubs. And they've now just been cut off at the knees completely because with the Red Sea trade rerouted, no one needs them anymore. Ships don't need to stop there. No one needs to invest money in these kind of inland development zones that were beginning to gain traction. And then finally, as you alluded to, Sinead, Europe's brave retailers are not having a good time of it, because if you're a fashion brand or you sell electronics, late inventory stockouts, massive shipping surcharges are your worst nightmare. You'd have thought that European manufacturers and retailers might have learnt their lesson from the COVID crisis and built slightly more robust supply chains and improved their inventory management, but this time wasn't different. So
Yeah, and it's not just countries and companies, right? Because the shipping lines themselves are stuck in this kind of weird middle ground. Yeah, they're making more per trip thanks to these kind of higher freight rates. But those trips are longer, as we've discussed, a hell of a lot riskier and way more expensive to insure. They're navigating war zones, they're hiring private security, which, oh my God, is this fascinating and insane black market in itself. They're burning more fuel, they're spending more time at sea, and they're pushing their crews to the edge. I mean, you could not pay me to get onto one of these ships. Margins are holding for now, but one more bad month, one hit vessel, one surprise blockade, and the whole model flips.
yeah, so to survive in this new infrastructure arms race, you need deep pockets and friendly insurance providers and data, but also, as you alluded to, need military power. Like whoever now controls the ports and the security around them increasingly just controls the flow of goods.
And freight used to be this super dull, boring commodity business that no one wanted to get into. But now it really is more like energy. It's strategic, it's volatile, deeply tied to state power, and has this kind of security requirement around it. It's often militarily backed. So it's no longer just about logistics and is becoming increasingly about geoeconomics.
So, but imagine if a country did actually operate the way global shipping does now. Its GDP would swing wildly based on drone strikes. Its currency would be priced by piracy risk. Its ports would get blockaded by drought, and its trade balance would depend on Twitter and Truth Social to some extent.
I mean, that's terrifying. But freight used to be extremely modelable, and you'd plug in the distance, the fuel price, port fees, all that kind of stuff. You'd estimate shipping costs like clockwork because they really never changed. And that's why these massive retailers built entire business models on just-in-time inventory, because this trade system was so stable. That world is now over. Today, you cannot model your shipping costs without factoring in weird stuff like droughts in Panama, and as we've discussed, drone strikes in the Red Sea, and again, going back to Twitter and whatever Trump decides is going to be a trade war or not in the morning. This is Excel meeting insurgency. And your 4-week logistics chain has turned into this new type of casino, which of course hedge funds love.
And yeah, so as in any casino, the house always wins: the insurers, the underwriters, the reinsurers, the hedge funds, and the rest of us, retailers, manufacturers, small shippers, are just trying to navigate a system where the rules change every week. So if you're a quant at a hedge fund and you've designed a model that can predict all of the above, get in touch. We'd love to hear from you.
So, what have we learned? That the backbone of global capitalism, the kind of system that moves your clothes, your phone, all the cheap shit that you buy from Temu, is now behaving like an unregulated, underinsured emerging market with 2 bottles of red wine kind of hangover.
Yeah, we built the system for scale, not for resilience. And as the supply chain turns into a risk trade, that scale is really beginning to turn against us.
And whether it's your $28 bottle of shampoo or a 10-ton shipment of lithium batteries, everything you buy now is now priced by weather and war. And so, welcome to this new choke point capitalism, when we really don't know what or when our entire global system is going to plunder. On that note, we're going to leave it there for this week. Thank you for listening to But This Time It's Different, and we will see you next time. Bye.